In today's video, I'm going to discuss the coronavirus, the economic implications, potential recessions, stock market, and how you can continue to build wealth. The whole world seems to be talking about one thing, the coronavirus or COVID-19. So let's talk about some of the potential threats here. First off, it's a brand new virus, or at least the first time we've had to deal with this virus on a large scale. So we don't know that much about it. We don't understand fully the pathology of the virus. Of course, we haven't had time to develop vaccines. So virtually everyone is vulnerable. And outside of direct contact, we're not even sure how it spreads as far as how long it can live on other surfaces. I mean, if you go to the CDC website to learn about the virus, it literally states in bold here, we are still learning how it spreads. I think what's really important for everyone to understand is that really what we're trying to do is make sure that everyone doesn't get the virus at the same time so that millions and millions of people have it. And even if just a small percentage need to be hospitalized to get over it, that could really flood the hospitals and our healthcare system. I think Dr. Foreman of Yale University explains it well.
We can accept the idea that maybe 30 million, maybe 90 million people in the United States, maybe even more, will become infected with this over the next 12, 18 months. What we cannot afford to have happen is for 30 million people to become infected over the next 3 months or 4 months or 5 months. So let me just say that I think for the short run, anything we can do to mitigate a huge spike in cases will serve us really well.
So how do you prevent a disease from spreading if you're not entirely sure of how it even spreads or how long it can live on the surface of your door handle or how to even efficiently and effectively test people? Well, basically what you do is you shut everything down. So as much as I wanted to watch my favorite basketball player, Cassius Winston, bring another championship to Michigan State, I have to respect all of the due diligence that everyone in charge is making to prevent large-scale spread of this virus, and it's going to save lives. Okay, so now let's transition to economic impact. Obviously, these preventative measures are going to have some type of an effect. I've mentioned March Madness. Last year, for example, in 2019, during the month of March of that basketball tournament, there was over $900 million in revenue from ticket sales and vendor concessions and things like that. Those $900 million in revenue went to someone's bonus and someone's income and went to a lot of different areas that are just evaporated overnight. That is going to have a serious impact. Everyone's spending is another person's income. Also, on a very fundamental level, companies are valued based on revenue, earnings, tons of different metrics. But at the end of the day, if they're not able to sell more products, well, then the value of the company, of the business, isn't worth as much. So what happens? Of course, their stock price reflects it. So what we have seen in the market, this up and down swing, is really investors trying to understand how do we value these companies with this major pullback in spending. Now, with all of these big market swings, of course, people are going to be asking, how can I build wealth and make money off of this market volatility? And if there's one takeaway you can take from this video is that nobody knows and nobody with any level of certainty can make profits off of the market going up and down. Of course, there are a few things that you can do, like either on a tax standpoint, maybe doing some Roth conversions, consult your CPA or financial professional to help you with some of that. But as far as making money off of predictability, nobody knows. So, and we're going to come back to this in a second, because of course that doesn't mean just stick your head in the sand. There are some things we can do. Now, the second thing I want you to take away from this video is not to panic. Nobody ever built wealth panicking. And that really goes hand in hand with not feeding too much into the news. The news and the media make money off of viewers so that they can get more money from ads and revenue and things like that and from the commercials. So what we need to do is understand that the news media has an agenda. If it bleeds, it leads, right? So I want to start to kind of just show you a couple of news headlines that you're probably going to see this week. So number one, President Trump declared a state of emergency or a national emergency against the coronavirus here. And really what that does is it allows states and other agencies to access kind of backup and reserve funds and money to help contribute towards the cause here. The second headline, The Federal Reserve on Sunday, March 15th, met a couple days earlier. They're going to say they had an emergency meeting, and what they did was they cut interest rates virtually to zero. The Fed is just doing what they can to try to support the economy and try to encourage people to continue to spend, maybe refinance that mortgage, put more money in your pocket in a different way. The next headline that you're going to hear is that we're in a bear market. That simply means that the market is down 20% or more from its all-time high. Yes, we're down a little more than 20%. So we're in a bear market. And just to give you some context, since 1929, we've had 24 bear markets. So about one out of every three and a half years, we have a 20% drawdown or a bear market. The average drawdown is about 33%. And what's really interesting is that on average, to go from peak to trough and then back to where you started takes about 26 months. So really just over 2 years, most bear markets are able to fully recover. Now, the last scary headline that you're probably going to see flash across your television screen this week is, are we going into a recession? Now, the definition of a recession is traditionally 2 quarters in a row, so 6 months, of GDP decline, negative GDP. So a shrinking economy for 6 months. So based on a lot of these preventative measures that we have, where we're canceling events, we're working from home, all of these different things are certainly going to slow down the economy. There's no question. Is it going to last for 2 quarters in a row to call it a recession? I don't know. I honestly don't care of what we're going to call it or what's the definition. I know for sure, though, that there's going to be some serious impacts. I don't want to take away from that, but I do want to shed some light on we are all in this together, and I want to show some statistics here from one of my favorite financial bloggers, Ben Carlson. So what you're looking at here is the S&P 500 performance post-recession since the modern era, or after World War II. Now, the average recession you can see was 11 months, and the average GDP decline was 2.4%. Now, since the last day of the recession, 1 year later, the market on average is up 15.3%. And for 3 years, it's up on average 45%. And from 5 years out, it's averaging 120% growth. Now, I don't want to claim that these statistics are going to continue in the future or that we're even going to have a recession, but I just wanted to shed some light that recessions don't have to be that scary. Now, I want to end this video with something tactical that you can use to continue to build wealth through any economic time. It's a very simple exercise that I call the stair-step system. And really what it's designed to do is help you identify where to position money. So I have people ask all the time, what's the best investment? It depends on what you're trying to accomplish. There's different tools for different jobs. So we need to start on the first stair step. What I want you to do is think about, what do I need in the next 1 to 3 years? And what accounts should I use? Probably bank account, money market, maybe short-term bonds, whatever the case. And this is where your emergency fund, short-term expenses, maybe a down payment for home, vacation, and living expenses. If you're in retirement and you're withdrawing money from assets, you need to have some money in very accessible liquid cash that is not susceptible to market declines. We just saw that it takes on average 2 years for a recession to go from peak to trough to back to where you started. I don't want to be selling when the market is low. So how do we avoid that? Having an emergency fund. You got to have a war chest. Now, number 2, we're starting to go up the stair step. I want you to be demanding more return on your capital if you don't need it for long periods of time. Now, the second stair step is a really tough place to be in today's environment because fixed income is really, really low. Of course, last stair step, this is where we can start demanding the most return on our capital. I'm not quoting that we're going to be getting 7% or 2 to 3%. These are just kind of nominal returns that we could be using, or at least I use in a lot of my projections when I'm putting together a financial plan. Again, nobody knows where the market's going to go in the short term, and nobody can profit with any level of certainty or consistency off of short-term market movements. So we need to build globally diversified, low-cost, well-designed portfolios based on your stair step, based on your time horizon, so that when the market is down, you don't have to worry. I hope that you found this video to be helpful, and happy building wealth.
Can I get a 20 for a real good time? 2 10s, I'm not trying to go crazy.